Hey, good morning. Mike Wright here with Tax Right. It's the Red Shoe Business Club that I'm very proud to be the sponsor of, and I welcome you here today. This is the 23rd session of the Red Shoe Business Club introductory programs on Facebook Live. We are talking about deductions. This is the third episode where we're going to talk about deductions. I see I'm cutting off the top of my head on the camera, but I guess we'll get over that. You remember we talked Monday about ordinary and necessary. Yesterday we talked about capital expenditures and the fact that you have to depreciate capital expenditures. And there are a variety of ways to depreciate them. The most common way being to take off a piece every year. And after we talked about that, I brought up the issue of what we call accelerated depreciation. There's straight line depreciation where you take off an equal amount each year. There's accelerated depreciation where you use different formulas to take off a larger portion of the cost of the depreciable item in the first year and then lesser amounts in the subsequent years. And then we also have the special depreciation allowance, which I may have said yesterday allowed you to take 100% of the cost of the item. Well, that's no longer true. That's a declining amount, and I apologize for misspeaking. But for 2022, or 2023 rather, the amount that you can deduct by the special depreciation allowance is 80% of the value of the item. I also misspoke on one other issue, and that has to do with land. I said that land was not depreciable. That is absolutely true. But I also said that you take off the price of the land all in the first year, and that is absolutely false. Land is not depreciable, and so you get no depreciation for it until you sell the item. Remember, it's a capital expenditure, and that means that it can only be dealt with as a capital gain or loss, which means it only shows up when you sell the item. So, or when you use it up, and of course you can't use up land, that's why it's not depreciable. But when you do dispose of it, or when you do have to settle up, the value of the land undepreciated is taken off at that point. And we'll talk more about that issue, about what you do with depreciation during a sale in tomorrow's program. But what I want to talk about today is another method of depreciating property that's a very powerful tool. And you may have heard it named, and that's Section 179, deduction. Section 179 refers to a section of the Internal Revenue Code, and what it allows is the deduction of an item all at once. If it qualifies as a Section 179 property, you can deduct it all at once in 1 year based upon two limitations. The first is the dollar limitation for the deduction, and the second is an income limitation. So let me explain what that means. For the year 2023, you can deduct any item or combination of items. I'm sorry, I did that wrong. It's $1,160,000 up to property worth $2,700,000. So you can deduct any item or combination of items that qualify as a Section 179 property up to $1,160,000. And the reason I started to write down the wrong amount was I started to put down the 2022 amount. You see, this is adjusted for inflation, which means that each year there is a new limitation that applies to Section 179 property. Why is this so powerful? Well, I'm sorry, there is one other qualification I have to bring up, and that has to do with SUV, vehicles that are SUVs or heavy SUVs, the larger SUVs, not your Honda CRV, but your Cadillac, what do they call that? You know, those big black cars that the CIA uses to run people around in. Those kinds of SUVs have a limit for Section 179 property of only $28,500. Also, real property cannot be used as a 179 expense except for certain improvement properties for non-residential properties. And those certain improvement properties include remodeling of the insides of offices and the replacement of air conditioners, roofs, and things of that sort. I repeat, this kind of 179 property is only available for non-residential property. Other than that, almost any other kind of tangible personal property is eligible for a Section 179 deduction up to a total, either one item or a total of many items of $1,160,000. All at once. It all goes away at once. There is an income limitation also, and that income limitation is the taxable income for the business. If the taxable income for the business is less than $1,160,000, then you cannot get a loss based upon a Section 179 deduction. You can only take your tax to zero. However, and this is the powerful part, you can take any leftover Section 179 deduction and carry it forward, an unlimited number of years forward, which means that next year, if your taxable income is under $1,160,000, you can tack on whatever is left over from this year and take it off of the next year's income as well. And if you go over the limit for that year, you add it and you go forward the next year. Why is this so powerful? It's powerful for this reason. If you're taking a standard deduction and a standard depreciation amount, and you come up, you cannot use a loss for that depreciation either, but it does not carry forward. All you get is the depreciation that's attributable to this year, and you lose any tax savings that you got by having more depreciation than your income allowed for. It stops. So one of the first things you have to look at when you're dealing with a decision between, do I do accelerated depreciation, or do I use the special depreciation allowance, or do I use Section 179? This is a tool that you can use for tax planning for the future. And it's a tool that you want to be sure that you have in your arsenal as you go forward. The other thing you have to be careful about is that the limitations for the state that you operate in may be different than the limitations for the federal government. That certainly is the case for some things in Indiana. So while choosing between these different kinds of depreciation deductions, don't overlook what the impact is on your state taxes as well, because the total dollar amount may make more sense to take one version rather than the other because of what's going to happen to you when you do file your state tax. One other thing to remember, and again, this presages what we're going to talk about tomorrow when we talk about selling capital items, and that is this. A Section 179 deduction has to be recaptured if you sell or cease to use the property that was included in the 179 deduction. If the span of the depreciation of that property has run its full course, and you'll remember yesterday we talked, 2 days ago, we talked about most property. Well, I think I pulled down the wrong sheet. I did. There it is. There's the sheet I want. Is either 5-year or 7-year. So if you say have a car that qualifies as Section 179 deduction, and which has a 5-year lifespan, and you keep it and use it for 6 years, and then you dispose of it, you do not have to recapture any depreciation from that sale within the 5-year period. However, if you sell it before the 5 years are up, then you have to recapture the depreciation as though it were depreciated in the normal fashion. This is also something to keep in mind because it allows you to avoid the recapture problems that the sale of capital property often creates. And like I said, I'm going to save that full discussion for tomorrow. Oh, we've got plenty of time. I was concerned about the timing. The thing you want to remember about Section 179 property, particularly if you're dealing with real estate improvement property, is that it can only be applied to non-residential properties. This is an important distinction because if you can't use the Section 179 deduction, then you must use the standard depreciation deduction, which again, referring back to yesterday, for non-residential property is 35 years. So if you're making an improvement, excuse me. So if you're making an improvement to an office that you lease and then you do leaseholder improvements to it, and those might qualify, if those do not qualify as improvements under these requirements, then you're going to have to depreciate them over 35 years, which is the life of the building itself. The problem is a bit more complicated with residential properties because in general, residential properties, when you have the kinds of repairs that we're talking about here, the kinds of improvements we're talking about, those are typically impactful for the residents. Now stop and think about this for a minute. If you're remodeling an office for a retail store or remodeling a retail store, those improvements are specifically placed there because of what the owner of the business that is making the improvements wants. And so they're much more temporary in nature. It's not likely that if you have it set up for a jewelry store and then you want to bring in a clothing store, the remodeling of the store space is going to be completely different, which means it is likely to happen more often. However, if you're selling a residential property, the way that property is when it's sold is generally the way people want it to be when they buy it. They may make improvements of their own later on, but because they're buying it the way it is, it's not the kind of thing that will typically change. So residential remodeling, residential improvements are generally not considered Section 179 improvements. They're considered normal depreciation, which goes with a 27.5-year period. However, there are certain circumstances where we would argue, and successfully it has been done, that some of these kinds of improvements, such things as replacing roofs, replacing heating and air conditioning units, HVAC, and so forth, rugs and carpets and things like that, can be handled as ordinary expenses because they are not permanent to the dwelling. It's true that an HVAC system is installed in the dwelling, but it's not like the plumbing pipes. It's not like the bathroom fixtures. These are all things that can be changed because they have a lifespan that is much, much, much less than the lifespan of a dwelling. But if you add on another bedroom, that becomes a permanent part of that dwelling forever. Well, at least for as long as the dwelling goes on. The logic is similar, I think you can get the logic as to why residential improvements are not treated as Section 179 property, whereas non-residential improvements can be. But there is an out, as I said, in treating those mechanical features as expenses because they're mechanical issues, or at the very least, treating things like HVAC as an equipment purchase rather than as an out-and-out expense and depreciating it over that period. But they still don't qualify because they're residential as Section 179 expenses. So what I'm trying to get across to you today is this, and I'll repeat this from several other days before that we've talked about this. This is not intended to be an exhaustive explanation of depreciation. If we were to look at the publications that the IRS puts out for depreciation, they're 75, 80, maybe even 100 pages, depending upon the edition you have. My point is, it's a complicated thing, and there are many exceptions. There are a lot of things that as you're reading through those instructions, it says, accept this, accept that, accept another thing. Pardon me. And because of that, you want to be sure that what you're looking at is specifically applicable to your particular situation. And the purpose of this program and the purpose of these 3, soon to be 4 days of discussion about deductions for expenses is just to make you aware of the kinds of things that you need to be aware of so that it will trigger a question in your mind. Hey, I'm putting in a new HVAC system at the property I rent. Is it deductible? Is it depreciable? How do I deal with it? Or going back to just ordinary expenses. Hey, I'm going to buy a new desk for my office. I'd really like to have that new one from IKEA that costs $5,000. Is that a reasonable office expense, since I know I can also buy one down at Walmart for $250? These are the kinds of questions that you want to consult with your tax advisor about so that you will be comfortable in knowing that what you're doing is both appropriate, legal, ethical, and makes you feel good about doing it. And this is the kind of thing that it makes it worth your while to talk to an advisor about. These are suggestions. These are things to think about, things to ponder. But when it comes to your particular situation, you want to talk to an expert. And that's what we're about today. So tomorrow, when we do Deductions 4, we're going to talk about the disposal of capital property, whether it's a car or a house or whatever it is you're getting rid of, because we want to talk about what the consequences are of selling something that's going to be taxed as a capital expenditure rather than simply being taxed as an expense. So join me tomorrow, same time, here on Facebook Live.